Hello everyone and welcome to This Week in the Markets. So there hasn't been much significant economic events this week and many traders are still on their summer holidays, which led the market to trade in quite a tight trading range. So rather than going through the news, this week we're going to take a look at 3 asset classes that we find interesting and discuss our outlook and the current factors that are driving these asset classes. But before that, we'll have to go through to our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So last week, equities have been pretty much bounded by a tight trading range because of a lack of any significant economic events, and also because traders are still away on their summer vacations. The S&P 500 is now just less than 2% away from a new high, thanks to Mario Draghi's pledges to take actions, and also because of a stronger than expected economic data in US. However, our concern is that the index have been rallying and making bullish breakouts, while trading volumes has continued to decline. From a technical analysis perspective, this demonstrates a lack of momentum and we could potentially see equities pull back in the short term, especially when traders return from their holidays and see the index trading at a key resistance level. Also, if we consider the AAI Investor Sentiment Survey, as we can see here, the bullish sentiment on retail investors have jumped up rather quickly over the last few weeks, and it is now at the highest level since April. While this is nowhere near a long-term overbought level yet, but we might start to see some profit taking at this resistance, and in the short term, we could see a small pullback. So other than the scheduled economic data, we think that the key event to watch out for in the short term is the Jackson Hole meeting, which will be at the end of the month. Fed Bernanke usually uses this conference to signal potential monetary policies, such as when he implemented quantitative easing too. If he does not offer the market any signs of actions, the market could be disappointed, and it could also lead to a small sell-off. Now the next asset classes we'll look at is the US Treasury. In the chart here, we have TLT, which is an exchange traded fund that tracks a basket of 20 plus years to expire Treasury bonds. This ETF has been making new highs and because traders are so concerned over the debt crisis in Europe and the fiscal cliff in US and also the slowdown in China, that really they just want a return of their money rather than being concerned about the return on their money. The yields on the 5 and 10-year Treasury bonds are now already less than the inflation expectations and therefore are at negative levels. The 20-year bonds is also not too far from that either. We don't think that the bond yields are sustainable at such a low level because eventually traders need to move their money out of bonds and put it somewhere that is actually making them a real yield. In the short term, the factor that could potentially be the catalyst for such a shift could be the Fed falling short of intervening in the bond market. We think that there is very little reasons for the Fed to continue taking down bond yields because yields are already at extremely low levels, as you can see. At the same time, equities are just a few percentage short of a 4-year high, so it is very difficult to justify the need to implement emergency actions. Moreover, it seems like the ECB will start its bond purchase program soon, if not in September. If that happens, it will create less demand for US Treasury bonds as well, and instead bond investors might turn back to sovereign bonds in the Eurozone to front-run the bond purchase program. And as long as equities and other high-yielding assets such as the Australian dollar and New Zealand dollar remain at these elevated levels, it will help to reduce investors' risk aversion and money could start flowing out of US Treasuries in search of higher yields. For these reasons, we are quite bearish on TLT from a medium to long-term perspective, especially after the break below the support at 124 yesterday, because it just helps to confirm the momentum from a technical perspective as well. Accordingly, because we are bearish on TLT, we are also bullish on TMV, because TMV is a 3 times leveraged ETF that tracks the inverse performance of TLT. So what that means is that if TLT goes down, TMV is expected to go higher by 3 times as much. And finally, the last asset class we'll look at is the dollar yen. We mentioned the dollar yen in last week's video because we said that we noticed in the 4-hourly chart there seems to be something or someone aggressively buying the dollar yen whenever it got near the 78 level. We speculated that this could be a stealth intervention by the Japanese government, but obviously there is no proof for this, nor is it really that important. All we know is that there is positive momentum pushing the cross up, and generally we like to trade with the line of least resistance. Factors that could push the dollar yen higher potentially, other than the government intervention, is again if the Fed fails to announce another round of quantitative easing program. Quantitative easing has the side effect of weakening the US dollar, as the program tends to expand the monetary base in US. And recently there has been some expectations of quantitative easing built into asset prices because of the underperforming jobs market in US. However, if this expectation is cut, it could strengthen the US dollar and in turn push the dollar yen higher. Another reason that could lead the dollar yen rallying is the decline in risk aversion. The dollar yen, or rather the Japanese government bonds, are generally considered as safe haven assets because a large proportion of its bonds are held domestically through mums and pups investors. And so it is less of a subject of the bond vigilantes, and at least in the short term. However, traders are starting to see opportunities in higher yielding assets such as equities and Australian and New Zealand dollar. And so the breakout that we are seeing in the dollar yen in the last few days could be just the beginning of a shift from safe haven asset to high yielding assets. So we are bullish on the dollar yen from a short to medium term perspective because of this. Well, that's all from us this week. In the coming weeks, potential volatility might arise from the Greek deadline on the 20th of August because they have to finalize a new austerity package. And also, the results of the FOMC minutes will also be released next Wednesday. And we could get a clearer picture of the Fed's inclination for additional stimulus by looking at the minutes. Although our suspicion is that most Fed members will probably still remain dovish, but it's probably difficult to justify taking these emergency actions when equities are almost at a new high. But we'll look at this in more details next week. Until then, on behalf of the Trading Pursuits team, we wish you all a profitable trading.